Welcome to Value Plus, the family office. Knowledge Plus for Wealth Plus presentation from our research desk. This week, our hot topic is risk profiling. But before that, let us see what happened in the financial markets last week. India's trade deficit for the month of August narrowed to $10.9 billion as against $12.26 billion in July 2013. The lower trade deficit will lead to higher GDP growth, low volatility in rupee, and the economy downgrade fear will also reduce. TRAI recommends big cut in base price for upcoming 2G auctions. This will have a good profit margin improvement for the telecom operators. Voice and data charges also may not increase as cost of spectrum will reduce. So the Sensex rose by 462 points, that is a positive of 2.40%, and closed to 19,732 at the end of the week. FIIs remained net buyers in the equity segment with the net inflow of Rs 5,490 crores and net sellers in the debt segment with the net outflow of Rs 2,071.5 crores. The chart shows the price performance of different asset classes. Dow Jones was the greatest gainer with a positive of 3.04%, followed by Sensex, which is a gain of 2.40%. Gold and silver were the major losers last week because better than expected Chinese economic data and reduced tension in Syria showed profit booking in gold and silver. Next week, the financial markets will be eyeing on wholesale price index data for the month of August 2013, which is to be released on 16th September 2013. Also, Federal Open Market Committee meeting is scheduled on 17th and 18th September. The committee would provide an indication on the timing and the size of Fed's cutbacks in its bond purchase program. RBI will release its next mid-quarter monetary policy review on 28th September 2013. Now we come to our hot topic of the week, that is risk profiling. Last week we had discussed the most important aspect, that is asset allocation and goal-based asset allocation. Now we come to another major aspect, that is risk profiling, which is one of the most important part of the investment process, and it also plays an essential role in ensuring the suitability of asset class in your portfolio. Every asset class may not be suitable to every individual. It depends on person to person, depending on his risk profile, depending on his time horizon of the investment, etc., to ensure that the portfolio is clubbed with the best assets suitable to him. Risk profiling generally revolves around two questions. First, how much risk can you handle psychologically? And second, how much risk should you ideally take on? These two questions brings us to two important aspects. The first is risk tolerance, which is an emotional or psychological aspect. And second is the ability to take the risk, which is the financial aspect of an individual. The answers to both the above questions may not necessarily be the same. Now let us have a look in both the aspects into detail. Starting with risk tolerance. It is a measure of your willingness to accept higher risk or volatility. Those with high risk tolerance are aggressive investors because they are able to digest the loss in the portfolio and are willing to accept losing their capital also in search for higher returns, and vice versa. There is also an emotional aspect attached to it. An investor may have a high risk tolerance, but when the actually event is occurring and he is seeing his portfolio significantly down, he may not be willing to accept it and may take some decisions in panic. So, an individual should have a realistic understanding of his or her ability and willingness to stomach large swings in the value of his or her investments. It is a measure of how much risk you can handle, but that is not necessarily the same as the appropriate amount of risk you should take. Let us see how it is. The amount of risk that you should ideally take depends on your risk-taking ability. The financial risk capacity can be measured in different ways, including time horizon, liquidity, income, etc. Those with high income can take high risk investments because they fall in the amount of their portfolios will not make much difference in their finances. But an investor may also have a high risk tolerance, but if a small drop in the value affects his monthly budget, then his risk taking ability is considered to be low. So, in spite of having a high risk tolerance, ideally he should not go for high risk investment because any loss in capital will affect his monthly budget. Apart from these two risk aspects, there is also one thing called asset class risk. Asset class risk means every asset, be it safe or risky, comes with its own set of risk. The different types of asset class risk are equity market risk, corporate event risk, small firm risk, hedging demand risk, complexity or efficiency risk, liquidity risk. For example, if all your property, if investment is done in property, then you will be facing liquidity risk. Similarly, interest risk, credit risk, forex risk, extreme event, operational, regulatory risk, and so on. Now, there are some statistical tools available to measure the risk. These tools are alpha, beta, standard deviation, Sharpe ratio, R square. Alpha and Sharpe ratio measures the risk adjusted performance. Beta and standard deviation is the measure of volatility. And R square measures the fund performance vis-a-vis the movement with the benchmark index. Thank you. Please share your valuable feedback on our email ID info@valueplusinv.com. Thank you once again.